Right. Okay. G'day, expats. Thanks for joining us today. We're just going to wait another couple of minutes as we just see a few more people virtually filing into today's webinar, and then we'll kick into it. Just a bit of housekeeping. If you do have some questions, there is the question or Q&A box that you can actually click on the right-hand side via the GoToWebinar software. So if you've got any questions, drop them in there, whether it's tax related, property related, finance related, anything specific around, I suppose, expat generally, please feel free to submit that, and we'll get started very, very soon.
Well introduced.
I'll just double check to make sure everyone can see the slides. Looks like the slides have dropped off. We'll try that one again. Go. Just being technology, not liking it today. Let's try again. That's a bit better. So I'll just double check. Those of you who've joined us already, if you can raise a hand or just drop a comment, even in the questions or comment section, just to check that you can see those slides. Great. That's great. Thank you. Thanks, Abdul. That's great. Easy. We'll wait one more minute and then we'll jump into it. Alrighty. All right, I think that'll do it. I think a few more people are coming in, which is great. We'll kick into it and kickstart today's webinar, which is great. So thanks, and I suppose g'day, expats, ladies and gentlemen. Thanks for joining us today on today's webinar, where we are going to be talking about managing an Australian mortgage and property portfolio. We are doing a bit of a webinar series, and today's main focus is going to be on build, renovate, or develop. We're very lucky. Today we're joined with, I suppose, attendees in over 19 countries today. There's a lot of those joining us in the evening from Asia, I guess the afternoon, or probably just tipped over lunchtime, especially in the Middle East and Europe. And for those that have stayed up quite late in the US, thank you for joining us. As we move through it, if you do have any questions, please do submit those questions in that question box. We will be doing a bit of Q&A at the end, and we'll run through as many questions as we can before winding up for today's session. In terms of, I suppose, the agenda today, the three of us will be talking a little bit for a few different topics. But before jumping into that, a quick legal disclaimer. And just to summarize this, anything you hear today is not personal advice, whether it's from a finance aspect, a property aspect, or I suppose a wealth management financial planning aspect. If you do need advice, please do reach out. But anything you hear today should be consumed for information and entertainment purposes only. Who is the Atlas Wealth Group? Well, we are a leading provider, and right now we provide a multitude of services, whether it's through our Atlas Mortgage arm, the Wealth Management arm, and the Atlas Tax arm. We provide, I suppose, financial planning advice to clients in over 45 countries. We are regulated and licensed by ASIC, the ATO, as well as the DFSA, which is a local Dubai entity. We are all specialists in our fields, degree qualified with numerous postgraduate qualifications. The main areas that we focus on with our clients is tax financial advice, financial planning, mortgaging, tax returns and tax compliance, as well as pre-departure and repatriation reviews. Who are your panel hosts today? A couple of heads for radio, that's for sure. An old joke, but myself, I'm the Managing Director for the APAC region for Atlas Wealth Management. We've got Jeremy Harper, who's the Managing Director for Atlas Mortgages, and lastly, the Managing Director and Founder of Henderson Advocacy, which is also our panelist today. When we look at today's agenda and what we're going to be talking about, so we'll be focusing on a few things. Jeremy's going to be looking to touch on the current and landscape, especially around seeking a mortgage and the lending landscape, discussing the micro and macro economic factors kicking around today. Jack's going to be giving us some insight into the property outlook, what he's seeing and any opportunities that he's also seeing from developing property. And lastly, I'll be talking around some concessions and ownership structures towards the end. And then we'll open it up and do a bit of Q&A as we wind out. I'll now hand it over to Jeremy just to kick us off into the Australian interest rate and lending landscape. Over to you, Jeremy.
Thanks, James, and thanks everyone for joining us, for your time and attention. So what I want to start off with is giving a bit of a background on where rates are at. Obviously, every second news article and conversation around the barbecue is around what's happening with the RBA and rates. So where are we and where have we come from in terms of this rate cycle? So if we turn over the page, we can see here on the left-hand side just where we're at in the cycle. So you can see quite an aggressive hiking starting from May last year. Starting at that 0.10 coming out of COVID, and now we're seeing it 4.1. So the RBA has paused for the last couple of months as it's starting to digest some of that data that's been flowing through with the economy slowing, but it just gives us a bit of a visual around how aggressive this tightening cycle has been. And if you look at that in comparison on the right-hand side to some of the previous cycles where we have been tightening, you can just see just how quickly the RBA has hiked those rates, and that's having quite a bit of an impact on particularly younger families and first home buyers in the market in terms of coming to grips with a higher mortgage repayment on top of cost of living. But also, if we go over the page, James, what this also shows is not only have we increased sort of by that 400 points from the RBA, but leading into this coming out of COVID, a lot of people were or still on ultra low fixed rates. So that's causing quite a bit of a sticker shock. A lot of clients now coming out of their fixed loans and their dollar repayment is anywhere between 40 and 50% higher dollar repayment per month than it was just 2 years ago. So on the left-hand side, it's showing us that on the variable rates, this is released by the RBA just recently, shows you sort of how in unison with the RBA hiking rates, the impact it's had on variable loans.
Oh, sorry, Jeremy. I'm just having a bit of a tech issue. Sorry, ladies and gentlemen. It's just giving me a bit of grief on sharing a slide, which is always how it goes, technology. Give me one moment. Sorry, mate. Let's try this again. And yeah. Oh. One moment. Try again. One more time.
Gosh, not a problem. So lovely. Okay. And then what you can see on the right-hand side is that sort of that J curve trending upwards on the fixed rates as people are starting to roll off. What does that mean for people who are looking to originate a new fixed loan? And it's coming off that sort of that low 2% base that was available during COVID. And now if you're looking on that orange line to lock into a new fixed loan currently, you're sort of now gone from that 2% up to see around that 6% plus. And on the right-hand side, I've got a little graph that breaks down. This is the fixed loan portfolio for Commonwealth Bank, largest lender in Australia. And it just shows us for their portfolio when they anticipate some of those low rate fixed loans to roll off. And you can see there, you know, obviously December and June quarters have passed, but you can see there that the upcoming December period and June and December next year, there's still quite a large portion of fixed loans to roll off as well. And I think Jack will probably touch on this later, But as you're starting to see some of these loans come out, people, particularly coming into spring now, people are going to have to make that decision around what do they want to do with that property, which is now going to impact the holding costs of holding onto that property that maybe they've sat on the sidelines for the last couple of years. So that it will probably translate into higher stock into this upcoming spring period. So where do we think, or where does the future markets predict rates will go next year? So if we change the page, you can see that the ASX, the 30-day future implied curve, it sort of has the cash rate really, we're at the peak per their future market, topping out about that 4.1 where we're at now. Previously, if we went back a couple of months, this was at seeing about a 4.3, 4.35 peak, and even some of the economists now are saying this is around the peak of where we expect rates to be. And then, as you can see there, the futures is pricing in some cuts in 2024, particularly in that second half of next year, as that data starts to flow through, people come up to fixed loans, and as that starts to filter through what's going to happen to the economy with that slowdown. So if we turn over the page, as I was saying earlier, with this rate tightening cycle, the people that are really feeling are the households, so young households, first-home buyers, and that's really shown in this graph, which was updated last month with the RBA. If you look at the savings ratio down the bottom side on the red graph, it shows that coming into COVID, people had a high savings ratio. And as the rates and rents and living expenses have increased, people's having to draw down their savings. So for some households, they're now starting to come into a negative disposable income every month as those outgoings have increased and their income hasn't kept up to date. And that's having an impact on the overall savings ratio. Now, this is in aggregate, so you've got to keep in mind that this is definitely impacting households very much differently based on their demographics and where they're based. So if you're a younger first-home buyer with a higher mortgage that you've originated in the last couple of years, this is probably more relevant to your actual savings ratio. If you're someone that's with no mortgage or a very small mortgage, maybe a bit more established in the market, then those people are sitting on very, very high offset accounts or redraws, or actually been building up their cash balance over this period. So it has been working very differently. So we're starting to see the market in Australia really segment in terms of the different demographics. And on the right-hand side, this really plays out not just for young mortgage holders or young families, but also for renters. So this was released by the RBA in April, and it's a sustainability report that they wanted to work out, okay, what's the stability or the financial stress for renters and people with mortgages? And if you look at the right-hand side, what it's showing there is per their indicators, they're saying that people who are renting are 4 times more likely to present financial stress compared to those with a mortgage. And if you look at the definition, what financial stress may mean, that may be going out without a meal, missing out on meals, not being able to, or seeking out financial help from friends or family. But that's showing us is not just people with mortgages that have had to deal with these increase in interest rates, but also people who are renting, because ultimately the rent has increased from the tenants, which we'll get to in a sec. So they're also feeling this sort of housing pinch around interest rates and rising rents. So across the page, so where are we sitting with inflation? So according to the ABS, it looks like the CPI has peaked in December. You can see there's a nice trend line there, 7.8% back in December. And we got the June readout, we're now at 6%. So it clearly showing that we have peaked from where we were back in December. There's still a few things to filter through that are unknown, mainly around electricity costs and rent, but it does look like, particularly around people purchasing goods, that has started to slow down that demand. So hopefully we continue to see this inflation number come down. But if you turn the page, James, you can see here one of the key drivers in the inflation has been rent, and the ABS has calculated that as a 6% increase annually. So in fact, 6.7%. But what you actually know is it's not really a true reflection. If you look at some of the metro areas over the last 12 months, so across Australia, rental has grown by 10.9%. and particularly led by cities like Sydney, 11.8%, Melbourne, 13%. So they're really driving that. So what I'd anticipate is that inflation number for rent to continue to grow for some quarters, which is going to be quite a big driver in keeping that inflation quite sticky. So over to Jack. Just going to take over the next slide.
You're a good man. Thank you, Jeremy. And thank you, James, for your top class tech abilities. So what I wanted to cover off in the few slides that I'll talk is the illusion that a lot of people have as when interest rates increase, property prices decrease, which we're seeing not actually come to fruition. I'm sure a lot of people, if you read any of the Australian-based media, have probably seen that property prices are going to come off 20, 30, 40%. Every media outlet has a different number. So I wanted to run through that. And then some of the macro trends we're also seeing in the majority of the metro markets in Australia. So if we look at the slide that we have here, it goes through over the last sort of 25-ish years, all of the different times in Australia where we've had a cash rate that the RBA has been increasing and the impact that's had on house prices. And as we can see, whether we look at June 94 to December 94, or we look at September 09 to December 2010, each time the cash rate has increased, we've still had different levels of property price growth, which essentially just shows that Australia's housing is not just driven by what the RBA is doing with interest rates. There is a lot of different factors that push housing. And one of the really big trends we're seeing at the moment is, although interest rates have increased, dramatically, due to the complete lack of really good quality stock, there has been a strong uplift on prices. So if we go to the next slide, James, what we will see is this is the total value of Australian housing. So back in December 21, March 22, that sort of 3 to 4 month period, Australia's housing peaked at being, I guess, the total value just over 10 trillion Australian dollars, which is significantly greater than the Australian securities market and significantly greater than the superannuation market. Obviously, we had some interest rate increases over that 12-month period, and there was obviously a drop there of around about 5%. But as we can see from March of this year to where we're sitting right now in August, September, the housing market has now had a bit of a reverse, and we're sitting back at levels that we were at in late 21, early 22. And the main reason for that, and the big driver, is because there is very little supply in any market across Australia, and there's a lot more demand for property than there is supply. And as we know, there is definitely some people struggling. We obviously saw Jeremy's slide there with the overall just total savings people are carrying now being less than what it was in previous years, but there's still a lot of people out there with money, and still a lot of people out there that need to buy property. And if there is not enough property to go around, then naturally we see an uplift in prices, which is what we're seeing. And we're obviously seeing a huge amount of migration going to happen and starting to happen, which will continue to put a upward pressure on prices. Next slide, please, James. So the macro trends we're seeing in the market right now, and we work all over the eastern seaboard of Australia, offices in Queensland, New South Wales, Victoria, and in Adelaide. In all of those markets, both metro and regional, there is a complete imbalance between supply and demand. So there is a lot more demand for property than there is supply. That's both in established properties and in brand new properties as well. Another impact, or one of the big impacts that's actually driving the lack of supply, is obviously the building pipeline is very slim. Everyone's probably been hearing about the increased cost of building, which has obviously put a dampener on people building new dwellings, and planning in Australia makes it very challenging also to get things approved quite quickly. But the other driver is that Australians are actually owning their homes longer than they ever have. So if we go back to 2008, 2009, the average home ownership in Australia was around 7 years. Whereas if we fast forward to 2023, depending on what market you look at, but if we do an average, the average home ownership now is around 12 years, which means we're seeing a 50% uplift in people owning their homes for longer, which essentially means when a home is sold these days, it's unlikely we're going to see that same property back to the market for a very long period of time, which obviously continues to put a constraint on supply. And usually what we find as well, the more premium the market, the longer they hold their properties for. Hence the reason we're seeing the upper end of the market. So if we're talking, Sydney, the circa $5 million plus, in Brisbane, sort of $3 million plus, and in Melbourne, probably similar to Sydney, $5 million plus, there is literally zero supply, and that segment of the marketplace is the strongest it's ever been. We're still seeing huge sales, and naturally, these people who are buying these homes usually carry very little or no debt, so they're not impacted by interest rates. The value in unrenovated assets is there's a huge disparity between unrenovated properties and renovated or finished properties. We see a massive opportunity in this segment of the marketplace, and we're buying an ungodly amount of these kind of properties for clients, especially investors, because there is an illusion that renovation costs or building costs are still, very high, and it's very hard to get tradies and all the rest of it, when in fact that's actually not true. So if you speak to most builders now, most builders' pipelines are very slim. They're starting to get a lot more competitive with their pricing. The supply issues are easing and have eased, and the main reason for that is because there's less building happening, and obviously the supply chain is improved. So unrenovated homes, people are walking into these properties and going, oh, we're going to have to spend a lot of money on this, let's not even go there. Where in actual fact, you can usually renovate a property and turn it into the renovated property, of which you pay a significant premium for, much cheaper than actually paying that premium. So there is an arbitrage there, and we're taking advantage of that. The A-grade stock obviously achieving premium results. That was what I was mentioning around the 5 million plus in Sydney and sort of 3 million plus in Brizzy. There's lack of supply and still a very, very strong demand for that kind of product. And another slide that I'm going to touch on later is the downsizer market is really driving that. So a lot of these properties that are in the sort of $5 million plus bracket are usually coming from people who have owned them for a very long period of time and bought them for a penny on the dollar. They're usually, your baby boomers who carry no debt on the property. And when they're selling out of these assets, they need somewhere to go. So that downsizer market, your full floor apartments, your townhouses, and duplexes that have level access and are close to all the amenities that a downsizer wants, are also in very, very strong demand. And going off the back of what Jeremy was saying with rental prices, obviously the rental growth in some marketplaces has been significantly greater than 6.5%. Some markets we're seeing 30, 40, 50% rental growth, and naturally it's the strongest it's been in a very, very long time. A bit of a misconception is that the rental growth has been strong for a while. In a lot of markets, rental growth has actually been quite stagnant for 5 years previous to now. In a lot of the assets that I own personally, we actually dropped rents, especially during COVID. So although it is strong, it is catching up, from years gone by. So if you average it out, it's pretty much in line with where it should be. And again, because there's less investors in the marketplace, and people, there was an article recently actually at the Financial Review just released, 1 in 8 investors over the last 12 months has actually sold an investment property, and 70% of the properties that have been sold have been purchased by owner-occupier markets, which is owner-occupier buyers, which is obviously then putting a greater constraint on rental supply. So that is what is happening right there. And Jeremy, I'll inside ball straight back to you, mate, for mortgage opportunities.
Thank you. So thanks for that, Jack. So if we turn over the page, just wanted to talk about sort of generally some of the options or opportunities in terms of on the mortgage side for expats who are on the call. I'm probably just for this call really focusing on points 5 and 6, or 4 and 5, just more around renovating and on the construction side. So if you're listening to on this call and you've got an existing property, I'm seeing personally a bit of a trend around people wanting to either get construction finance for what you call a non-structural renovation or even a structural renovation. So the key difference there is, does it need DA approval? Maybe on that smaller, quicker side, maybe getting some funds out to do that cosmetic facelift that Jack was talking about. Perhaps that will give us an instant uplift on that rental yield, or going down the path of, a structural renovation, putting on a second floor, knocking down some of the key walls and really extending out the property to capture more of that value. They're both options. They're on the table for expats. I have seen a few banks become a little bit risk off in this department in terms of pulling back from construction lending for expats, and I think that's just part of the cycle, but there's still options out there. It just means we have to look at other banks, not necessarily that first choice bank that we're always after. And then also seeing clients looking to, perhaps they've got a nice sized block of land, want to build and perhaps build a duplex or a triplex on there, particularly that duplex, which Jack was touching on before, that may be suitable for that ideal downsizer, where perhaps you go and sell that into the market, or hold on to it and rent that out for a premium, because you're capturing that downsizer market that may have deep pockets, so they can afford that premium rental income that you could charge on that dwelling. So there's a couple of options there, sort of tying back to that development or renovation type financing. So onto the next slide. Thanks, James. So this, just more generally, in terms of lending for expats, some of the opportunities and challenges, I think, particularly for the clients in the Middle East, being able to utilize that tax-free income, that is just absolutely golden. See, in Australia, most people are paying marginal rates. It keeps going up every year with the way inflation's going. You're actually getting that bracket creep. So being able to utilize your tax-free income for loan servicing and to pay down that loan is a huge opportunity that I don't think a lot of Aussies back home have that opportunity to utilize. Using property as a bit of a hedge against inflation, so capturing some of that increase in asset value. Using an offset facility as an expat overseas, again, particularly in a high or rising interest rate environment, where you can move funds from overseas, keep in your offset account, reduce some of that interest expense. Australia is a fantastic tool that most of the banks will offer to expats. And then, taking advantage of that sort of depreciating Aussie dollar, for clients that are pegged to the US dollar or similar, that work in unison, obviously you're seeing a higher purchasing power with your foreign currency at the moment. So some of the challenges, I think, there has been a bit of a relaxation from some banks towards expat lending. So the deposit required, that's moved. You can get in with a lower deposit if you're looking to buy your first property. It used to be sort of more 20-30%. Now some banks have relaxed that 5% if you need. And then just be mindful as a challenge, really just around that government and tax changes. And that's something that expats or locals need to be across. They're forever trying to change their ruling, and they're always trying to, take more, find a new way to tax us, really. And I think for people on this call, probably the main thing, a key one, is that land tax, which applies to both expats and Aussies on board or within the country. But that is something that you need to sort of tie into, particularly if you've got a property with a large land value and maybe you're not utilizing getting the return on that land. Your land tax bill may have gone up or grown at a rate that's far increased your rental increase over those years. And then just another challenge, if you're looking to buy with a spouse who may not be a citizen, just have to navigate what that means for you in terms of additional taxes. So over to the page, I will talk a little bit more specifically around just some of the key things to think about if we're financing a construction project as an expat. So if we turn the page, thanks, James. So what I'm saying is, as I was saying before, some of the lenders are a little bit risk off with construction. So it's really important to do your due diligence on those builders. So really do your homework. What projects have they done previously? Not just something that's completed 6 months ago or the project they did last month, but what's something they completed 5 years ago, or even outside the warranty period, and does it stack up? If you can contact some previous clients, I think that's really important, because ideally you want to get it done once and get done correctly with the right builder. Understanding the cash flow required with a construction loan. So I think the key thing is that the construction or your funding is required up front. The bank always comes in at last. So just keep that in the back of your mind, that the bank won't come in first. So you need to have that cash up front, and that could be via an equity release that we can do on a property, or cash or other savings that you can draw down on. Understanding that, and this is really interesting in this environment, the difference between a fixed build contract and a cost plus. So a fixed build is, this is where a lot of those volume builders, particularly in Victoria, got into trouble, got into liquidation because they entered into contracts with customers to say, yep, we'll build your house for 300,000, sign the contract, it's all locked in. Cost of materials go up, cost of subbies go up, all of a sudden the builder's making a loss. So the bank prefer this type of arrangement because it's all squared away before they even start to fund the project, but it's actually not working in the best interest of builders at this time. A lot of builders are trying to go down this what you call cost plus contract, where essentially they'll say to the client, we will charge you a margin of 20-25% on what it's going to cost us to build this. And that can be a fixed, it's obviously a floating amount because we don't know what the cost of materials will be for that build. You have to keep in mind that a lot of banks are not comfortable with their risk appetite going down that pathway because traditionally they look at that as sort of an open-ended check. And so they're a bit risk adverse to funding those type of projects. There are options. There are obviously banks that will lend under a cost plus agreement, but you just have to be mindful that it's going to be harder that way versus a fixed build contract, which is in line with the HIA guidelines. In terms of larger financing, so if you had quite a big block of land or a space and you're trying to finance multiple dwellings, residential lending typically taps out that 4 or 5 dwellings on one title to build. Anything larger than that typically falls under commercial lending. So that's just something to be mindful of. What I'm seeing in terms of valuations, and this is a function, people always get confused and assume a value is done by the bank. It's done by a valuer, which is assigned by the bank, but the values right now are quite risk off in this market. So as an example, I had a client building quite a high spec house up in Burleigh Heads. The valuer, the build contract was about 2.5 mil, and the valuer marked down the value on that to about 2 mil. So essentially, they valued the actual build as the cost of materials only, which just does not make sense. So that just shows that some values are incredibly risk off. So what that means is, if that's the case, remember that valuation is really just to sort of give us a snapshot of what this is valued during or once the build's complete. If that's the case and we can't challenge that valuation, and we don't have any other options, then you might need to put more money in for the build to bring down that equity or bring down that LVR. Of course, you can get that valued up at the end of the project and maybe get equity released at that point. In that scenario, we tried to challenge it. They dug their heels in. So we were quite fortunate. We just took the deal to another bank and it all got valued up correctly, second opinion. And I think that's something that's really important. A valuer is just a human being. It's just one person's opinion. It can be right, it can be wrong. So we can always test that theory out at market. When we come to financing, we can take in the proposed rental income. So let's say you're trying to build a duplex and there's 2 dwellings that will be done at the end. The bank's controlling the funds. We can use that proposed rental income for loan servicing. So that can help in terms of your borrowing capacity. And then, as I was saying earlier, around renovation finance, controlled finance versus cash out. So a big structural project or renovation you're doing, the bank will want to control the funds because they want to try and control that risk, versus that non-structural renovation. If there's sufficient equity, we could get cash out. That money could go into, say, your offset account. Let's say it's $100,000, and then you pay the invoices to get the landscaping to do the painting externally, controlling that, which just makes the project a little bit easier, a little bit quicker. So over to the next page. Thanks, James. Back to you, Jack.
Very well explained. Thank you, Jeremy. It was a good case study on Burleigh as well, mate. All righty. So this is the, I guess, opportunities we're seeing in the development space. So I personally develop property myself, and then we also do a lot of developing and major renovations on behalf of clients, and we actually run a building company. So switch to the next slide, please, James. There we go. So the big opportunity we're seeing at the moment, mainly for investors, is there's real value in cosmetic renovations on properties. Like I was saying before, properties that are unrenovated at the moment, I believe, are selling for less than what they are worth, simply because of the buyer's perception in the marketplace of what it's going to cost to renovate. And 9 times out of 10, If a property is structurally sound, it has a good floor plan, and all it needs is a facelift, those renovations are reasonably priced. And a rule of thumb that we like to use is, let's hypothetically say you're spending $1 million on a property. You would usually spend 10 to 15% of the property value, so between 100 to 150,000 on renovating that property. And we would want to see a minimum return on that capital injected of $2 for every $1 we spend. So if we're buying a property for $1 million, we're spending $100,000 on that property, we want to see a $200,000 uplift on that asset as a minimum. So we're getting $1 for every $1 we, $2 for every $1 we spend. And a lot of the time for our investment clients, we're holding the assets, we're just refinancing against them, we're releasing that equity out in that uplift. So we're essentially pulling all the cash we put in for the renovation plus our profit, and then we're obviously redeploying that capital usually into another asset. Something we're seeing with development sites at the moment is obviously you can't just buy a raw site and build on it straight away. You have to go through a process of buying it, getting plans, getting approval, and then getting a thing called a construction certificate. So it is a process, and depending on how complex the development is and the council you're doing the development in, that's dependent on how long it takes to happen. So there is a lot of people who have gone out, or developers, mum and dads usually, not property developers, but mum and dad developers who have bought sites. The sites didn't really stack to begin with, but they took a punt. They've gone through, they've done all the hard work, they've got the sites approved, and they've got their build costs, and they've worked out what their resales are going to be, gone through the construction finance process like Jeremy was mentioning, and then they realize that the site doesn't actually stack and they can't afford to hold it due to increased holding costs, and now they're going to have to offload the site. So I believe there's going to be opportunity in buying sites that are shovel ready, meaning you can actually start building straight away, which is obviously unique, and you're going to be able to buy them for a strong price. We've just done one recently where we bought a site off a lady directly from her, and we see that we can maximize the plans that she already had approved. She had a spec duplex approved, and we knew that area perfect for a downsizer. They want something which is luxe. So we went through and we did a section 47 with the council, which is where you can alter the current DA. We redesigned them both on the facade and the floor plans, resubmitted, got a delayed settlement on that property of 6 months. And by the time we settled, which was only a couple of weeks ago, we had the new approved plans and we're ready to build. So being able to look at sites and actually get them to their highest and best use can also work. Obviously, granny flat yields are very strong as well, and that's mainly due to the increase in rental prices. So granny flats to build, depending on where you're building them, used to probably be 1 to 130 to build, so there's 100 to 130 Australian to build. Now they're probably 180 to 200, so there has been a pretty significant increase in building a granny flat, but the rental income you would get from a granny flat has also increased quite dramatically as well. So if you calculate, you spend 150 to 200,000 on a granny flat, and on that granny flat you might get $550 to $600 a week as a rental return. If we do $30,000 a year on a $200,000 investment, the yield on that is extremely strong, which naturally is a really good play for cash flow. So if you've got an existing asset right now and you're feeling the pinch with interest rates, putting a granny flat where you could use some equity from the property to be able to build that granny flat will help cover all the costs of the mortgage that you have on the granny flat, plus help then cover the cost of the mortgage on the original dwelling as well. Granny flats don't usually add a significant amount of capital value to a property, so just keep that in mind. If you spend $200,000 on a granny flat, it's unlikely to add more than $200,000 worth of value to a property. They are very much a yield play. So we're doing that with a lot of our clients now, is just looking at their current portfolios and going, well, where can we maximize a return to make it easier for you to hold, and then also increase serviceability as well by increasing cash flow. So that's a good play. And then again, I'll talk about capturing the downsizer market. So it's Australia has an aging population. A lot of people have probably heard that. And as people get older and their kids move out of home, they want to get into something smaller, but they do not want to leave the community that they know, like, and trust. So there is a huge arbitrage there with being able to buy sites, build something for downsizers. They've probably owned their properties for 30, 40, 50 years. Some of them bought them for a penny on the dollar. Now they're selling them for $3, $5, $10 million, and they just want something to downsize into. And you can usually maximize the sale value, and then not as, worried about $1 or $2 when they really like something and it's going to see them out for the rest of their life. So the way that we think about downsizes is making sure that they're walking distance and level walking distance to cafes, shops, the medical center or the doctor, making sure that if it's a double-story property, that property has an elevator internally, or if it's a single level footprint, you have no stairs to be able to get up to the front door or internally. And making sure that it's something which represents the market that you're trying to capture. So if someone's selling out of a $5 million home, you don't want to put them into something spec, which is $600,000. You want to build something that they're going to enjoy living in and be happy to spend the money on. So they're the opportunities I think we're seeing in the development space. I think we're back to you, Mr. Ridley.
We are. It's been lovely sitting on the sideline, to be honest, and just letting you guys talk. I'll now jump into some general tax planning and just general considerations, especially around capital gains tax and things that you can leverage in the future when it comes to potential exit events out of property, and just consolidation events, just some general fundamentals, both for Australian expats and just normal Aussie tax residents as well. When we look at probably the main one that we all benefit from, assuming when we sell a former main residence, we're normal Australian tax residents, but the main residence exemption, it's a terrific tool in your arsenal where you can own a property, you can move into it, establish it as your main residence. And as the guys said earlier, a lot of people, they're buying homes and they're staying in them a lot longer. On average, going back, it was 7 years, now it's 12 years, and I guarantee it's probably going to be a bit longer when we go back and have a look at that stat in 5 years' time. But having that asset be tax-free that entire period is terrific. And that's what we're seeing right now from a lot of, I suppose, the older generation. That's why there's a lot of downsizing and cash buyers, and that's helping, I'd definitely say, add that cushion to the current property market, and that's why the property market's not dropping. When we look at the, I suppose, mechanics of the main residence exemption, if we buy a main residence, we live in it for a period, and assuming we don't buy another main residence, we can move out of it and rent that asset for up to 6 years. And that's really, I suppose, unique for Australian expats. When they head overseas, they can rent out that asset for up to 6 years, and that 6-year period will be tax-free. If they rent it out for more than 6 years, then there'll be a bit of capital gains tax that will apply. But the best way to look at this is probably looking at a hypothetical. So let's assume we buy a main residence, we move into it for 12 months, we move out of it, then we head overseas. We rent out that property while we're abroad for 5 years, and then we come back, and then we actually move back into it for a very short period. That entire period that we've rented out, that's tax-free from a capital gains aspect. So that's terrific. The other, I suppose, scenario might be a case where we head back overseas after being back for a short period. We rent it out again. We rent it out again for maybe another 5 years whilst we're overseas, assuming we haven't purchased another main residence in Australia. And again, that period is tax-free from a capital gains aspect. And then in this second period, let's assume that we're now renting it out for more than 6 years, and we come back on the 8th year. So technically we've rented out for more than 2 years over that second period of 6 years. What does that actually mean? Well, it means for your entire period of ownership, only 2 years are going to attract some sort of capital gains tax event when you eventually sell it. That is a terrific opportunity in the event you're going to refinance on it, pull out some equity, sell it, drive it into more assets, whatever it may be. But it just means that depending on different holding periods, you can access this great, I suppose, exemption or concession. Back in, I suppose, I'm going to say, but back in 2017, they actually announced the removal of the main residence exemption, and then it was finally legislated and was enacted as of the 30th of June 2020. So what that means is, if we're an Australian expat and we're a non-resident living overseas right now, and we sell our old main residence, which is probably an investment property now, we will pay tax on that sale going back all the period that we've owned it, and essentially the period that we lived in it counts for nothing. So I would say there's not too many Australian expats that I'm having conversations with this day that are looking to sell the former main residence. Right now, they're mainly looking at renting it out, and if it's grown in value, they might be looking at how can we use that equity to keep investing in a tax efficient manner. And I guess that's typically property. That's sort of definitely number one. But in the future, in the event you have to sell a main residence, it comes down to that taxing point, you signing that contract of sale. If you're an ordinary Australian tax resident, not an issue. If you're a non-resident, that could present a big issue from a tax point and what you might owe the ATO. So a very important one. And I'm still coming across some Australian expats which aren't aware of that. Capital gains tax. A common query that I get is, well, what are the tax rates for Australian expats in the event they're making a capital gain on property? They're actually just the non-resident income tax rates. We don't actually have different tax rates for capital gains. Capital gains are just treated as ordinary income in Australia, whereas in other countries, they are taxed a little bit differently. Probably a good example might be the US. Once you've owned an asset for more than 12 months, you get a discounted capital gains tax rate based on your income level. So that's a really unique one. But they're just taxed at our non-resident income tax rates. What are the non-resident income tax rates? Well, they're 32.5% on the first 120,000. Then it tiers up again for the next, I would say, 50, where it goes up to, sorry, the next 70,000, where it goes up to 37%. And then anything over that final amount is 45%. So rather punitive. So you need to have a strategy if you are going to release a property asset of how to reduce that. The concession that we used to be able to access as Australian expats was the 50% CGT discount concession. That was removed back on the 9th of May 2012. But the period that you've owned it as a normal Australian tax resident or lived in the asset, you still get the concession. So there's always a bit of confusion there when I'm talking to some of my clients and expats where they think they can't access that concession after that date. You definitely can. It's based on the period that you've owned it and the period of residency in which you've owned it. You can still access that concession. A market valuation can be really instrumental in segregating those different periods of residency versus non-residency, and just gives you peace of mind in the event you're ever doing any hypotheticals, buying more property, or maybe releasing one property so you can diversify across another property asset. That's a really important one. Plenty good online platforms. I think the one that comes to mind right now is probably Option Solutions. They're probably a national provider. A lot of clients have used them in the past. But market valuations are definitely important for breaking that up. Land tax considerations. This is starting to bite, and there's, I would say, every couple of years there's definitely some big changes that happen in a couple of states. Land tax, it's a big piece of the pie when it comes to revenue raising for each state. I think Jeremy and we've talked on a previous podcast episode that I think 49% or maybe 51% of the state revenue is through property transactions, whether it's stamp duty or land tax. So we can see that it's always revenue raising. But when we're owning a property, and depending on the state and the territory, if we're considered an absentee, we can actually inherit quite a large additional surcharge of anywhere between 1% to 3%, depending on the state. Unfortunately, they are all different, and I don't know them off by heart anymore. I'm not that good. Buying with a non-PR or a non-permanent resident or citizen, when that happens, that can actually attract a higher rate as well from a land tax aspect, and stamp duty as well. So a common strategy that we might employ with our clients when they're buying a future main residence might be a case when one member of the cohort, the family, the couple, they're buying the future main residence now. They're an Australian citizen, but their spouse isn't. Not PR, just a foreign resident, unfortunately. So we might encourage them to say, listen, let's just buy it in the Australian citizen's name for the starters. And when you move into that property, we could then look at adding you or adding your spouse now that they're a permanent resident onto the title, because most states do provide some sort of concession and they remove stamp duty. That's assuming that it hasn't been treated as, say, an investment property previously. But that's a really important one. When you look at stamp duty in most states, when it's a foreign acquirer, it can be up to 7%, the surcharge. And that's a huge amount on stamp duty rather than, say, the standard 2.5%. So just bear that in mind when you continue your property journey. Most states have minimum tax or land tax thresholds. They usually range from 299,000, 599, 595. That's Queensland. I'm biased on that one because I'm here on the beautiful Gold Coast. Another point I've put there is the taxable value from a land aspect versus market value. And a lot of expats often get it a little bit mixed up. So the market value will often be very different to the taxable value of land. We often get that annual statement from the local from the local council, and there's usually a huge difference. It might be a couple 100,000, sometimes it might be a couple of million. And the reason for that, looks very different from the council aspect, but just understanding that there is a very big difference there between the value of land and the market value. What I can sell a property versus the taxable value of land will be, yes, very different. So that's an important takeaway. When we look at some key themes that have come out maybe in the last couple of years, we're finding that a lot of state offices or offices of state revenue, they are starting to crack down on the change of use. So all that means is if we've purchased a main residence, we've moved into it, and then we've headed overseas on an expat period, we are meant to update the state OSR or the territory that it's now not treated as a PPR or a permanent place of residence. It's now treated as an ordinary investment property. You usually have a bit of time to do that. It's usually a year or two, depending on the state and territory. But once you've been overseas and you haven't lived in that property for a period, then you need to make sure you change it, because that's when you can inherit a nasty land tax bill. Most offices of state revenue, they sometimes can apply some general interest charges. I've seen client cases where the client's just come on board, they've rented out the former main residence and they've got 2 or 3 investment properties, and then somehow the local office of state revenues caught wind that the other property is now an investment property, and then they end up owing, you know, the worst case I've seen was about 200,000 to the Victorian State Revenue Office. So just be mindful of that and plan accordingly, and make sure you're on top of it as well. I'll move on to the next slide. Using an offset over a redraw. This is a really common one. Jeremy and I talk about this one a lot, especially when he's assessing and refinancing, but it's just being mindful of structuring your mortgage correctly. So in the event you are coming back or you're buying, say, another investment property or residence, that you're mindful of, I suppose, mixing your debts a little bit. So we love an offset account, especially if it's tied to an investment property, because it just means you can pull out the cash and then you can use that for further investing, or say maybe a main residence purchase in the future, but the interest expense will go back up because you're pulling offset out or cash out of the offset account. And the real benefit of that is that it still remains tax deductible. Whereas if I had a loan right now and I threw a lot of money into a redraw facility, and then I pulled money out of the redraw facility to buy a main residence, well, unfortunately, you've reset the loan portion, and now you've got a portion of your debt which is not deductible. So you're not being very tax efficient. So making sure you get your debt structuring correctly from the outset is really, really important. And often there is a lot of confusion around an offset account versus a redraw account. An offset account will be a separate non-interest bearing account. I know from personal experience, when I've used Commonwealth Bank, I've been able to set up a net bank saver or a transaction account, and I can go in the background and change it to an offset account. It's a separate account. Or I can put more money on the mortgage, and that's going into the redraw, where I can still access it, but it changes the purpose of those loans going forward. So again, I'm harping on a little bit, but just making sure you're getting your debt structuring correctly from the outset. Let's talk a little bit about preventing tax leakage where possible. When we look at some general strategies that we can employ, I suppose negative gearing, that's a huge one back in Australia. Everyone loves the sort of concept of negative gearing. If we're an expat and we've got no wage income back in Australia, and we're overseas, negative gearing isn't a big thing. However, you do get the opportunity to accrue income losses. And income losses are really important, and you're building a tax asset which you will be able to use in the future, whether it's to offset a future positively geared property, capital gains tax event, or maybe you return and then you're unwinding those losses when you're employed again back in Australia. So you can still use negative gearing as an expat, absolutely. But often it's a case where when we have a positively geared property, so the net income is higher than the relative tax deductions, then we end up paying a rather large amount in income tax. And the reason for that is our income tax rate is 32.5% as an expat, as a non-resident. So what are our options to reduce that kind of tax? Well, depreciation is probably an important one, especially if your property was built in the last maybe 10 years. You can get some really good non-cash deductions. When we claim depreciation year on year on year, just be mindful that it does have a cost-based resetting effect in the event you're eventually going to sell that property. And what I mean by that is, If I'm claiming, say, $5,000 per year for the next 10 years, $50,000 in total, then it means that $50,000 will actually reduce my cost base when I eventually sell it, creating a larger capital gains tax event. So it still comes out in the wash. If you're not going to sell the property and you claim depreciation, well, not really an issue. It's just giving that additional non-cash tax deduction. A super contribution, I guess I caution those that are listening and they're in the United States, just because super contributions can be sometimes a convoluted topic. But if you're anywhere else, contributing to super and claiming a tax deduction, it's a really tax effective strategy where you've got maybe your property asset or property portfolio assets growing a retirement asset. And the reason why you might do that is because you'll only pay 15% tax on the amount that you're putting into super rather than the 32.5%. So you're essentially saving yourself 17.5% tax, and you've got one asset funding and building up your retirement asset, which is terrific. What if we sell an investment property in the future? What are our options to try and prevent that sort of large tax event in the event we need to sell it and we're paying off the loan and we're deploying that capital somewhere else? Well, first and foremost, we check whether we have any capital losses, any income losses carried forward. And then we can use what's called the catch-up concessional contribution. In the current financial year, you can actually contribute up to $157,500 under certain eligibility criteria to offset that capital gain. And it means you only pay a flat tax rate of 15% on that amount you can get into super. That's a really complex strategy, and there are some certain qualifying criteria for it. So if you are going to look at doing something like that, please seek advice, really important. If we look at maybe an exit event in the future, consolidating and retirement planning, the downsize of contribution. It's a terrific strategy, and a lot of my clients have used it in the last 12 months where they might own a property asset. And what's really unique about this strategy is that if we're an expat living overseas, we might buy an investment property. We might have owned that investment property for 8 or 9 years, and then we return back to Australia, and then maybe we move into that property for 2 years. If we move into that property for 2 years, it's going to be entitled to a partial main residence exemption where when we sell it, it'll still be a tax event and we'll still have to pay a bit of tax on that kind of transaction. But we're eligible to move $300,000 each for a couple into super on top of creating a very large tax deduction depending on our situation. So we love the downsizer. And I guess to give you an example, a couple that might be coming back from an overseas stint that's owned an asset for more than 10 years, which was their former main residence, technically they can squeeze up to 1.57 mil into super within a month. So there are ways that you can do and squeeze a lot into super very quickly, which applies to if you have to sell a property asset. And that's mainly around what we talked about before, where we're downsizing. Maybe the current home, it requires too much maintenance. We want to move into a retirement sort of villa or something that's a little bit more low maintenance. So we sell the big juicy asset, mainly a tax-free transaction. We can squirrel a little bit more into super to shore up our retirement, and then we're downsizing, buying something a little bit more match fit for our current circumstances. Property ownership types, and just winding out my section, a couple more slides and then we'll jump into a bit of Q&A. Really appreciate everyone hanging in there for today. Joint tenancy versus tenants in common, really important one. And I had a conversation today with a client which didn't understand the difference. So I thought, what a great opportunity to actually talk about it. So joint tenants, when we're buying a property together as joint tenants, Jack and I go and buy a new house together as joint tenants. We own it equally, 50-50. In the event I die and I pass away, Jack automatically gets given the rest of my 50%. And that's the right of survivorship. So that's what that means there. If one tenant passes away, their interest automatically goes to the surviving joint tenant. And that's normal. All tenants have an equal interest, which is pretty standard. And I suppose joint tenants is typically how we would structure a main residence purchase with our partner. That's plain and simple. Tenants in common. Tenants in common might be a bit more specific around investment properties or buying investments with other friends and family. It gives us that select percentage or fraction where we can actually break it up, where we might own 1/3, and we've got 3 panelists today, so we all might own 33% each. In the event I die and pass away, Jack and Jeremy don't automatically get my 33%. My 33% goes into my estate. And let's say I've got 3 kids and I want them to receive an equal share of my 33%. After all that takes place, Jack and Jeremy own 33% each, and each of my kids own 1/9. And what's unusual, and I suppose a little bit frustrating when you come to having tenants in common, depending on how you structure assets, is it's not a case where it's a majority vote, to sell that asset in the future. If one person doesn't want to sell that asset, you can't compel them to. So I've seen cases where I've reviewed, I suppose, an estate getting wound up, and someone has owned 1/32 or 1/32 of a commercial asset, and that one person can be the person that doesn't allow the whole family to sell. So just be mindful of how tenants in common operate, and I suppose there is no right there, no right of survivorship. It's usually a good way to structure some investment properties for, I suppose, when we're on different income levels. Maybe we've got one individual which isn't working full time, they're on a reduced income, but we've got a property which is positively geared. It's got a high degree of income off it, and therefore we want to allocate more income to them. Therefore, we're reducing our overall income tax exposure. That's just being a bit more strategic. But a really important one, joint tenants versus tenants in common. A lot of people get it wrong. Last slide for me today, tax structures and what to consider. Right now in Australia, the most common tax structures that we can invest through is either ourselves as an individual or partnership, companies, or a discretionary trust. And lastly, a self-managed super fund, probably the most common. Working out what might be the right fit is going to be really individual and specific to your own goals. You've got to think about income tax. You've got to think about asset protection, retirement planning, succession planning. That example about the ownership type just there, negative gearing, that's a bit of a tax play, long-term refinancing, and cost to set up, as well as ongoing costs of that entity. Refinancing, you might set up a very complex structure to develop a property and build and renovate in the future. But if you've set up too complex and you go to Jeremy and Jeremy talks to all his lending panel and they can't understand what you've set up, then it's going to be really frustrating because you're really going to struggle to get further finance going forward. Jeremy's a gun broker, so he won't have an issue. But those are the cases that can happen when you get a bit too complex with your structuring. Because a lot of expats are joining us today, it's also a case where if we're setting up, say, a company or maybe a trust, we often need an Australian tax resident as maybe a director of the company or maybe a trustee in Australia as well to manage the trust. So just be mindful of that. You don't want to set up a trust, a discretionary trust, which automatically is a non-resident trust, because then you're losing all the tax concessions that you get when investing back in Australia. So it's just those little things, being mindful of structuring things correctly. And if you're unsure, seek advice, really important. We'll now move over to the Q&A section of today. I'm just going to grab a drink of water and then we'll jump into some questions. Thanks for your time, guys.
Well done, James.
Now, I've got some questions which I did promise some clients I would read out to at the start because they couldn't attend, but they want to make sure it's covered off in today's recording. So they're getting in quick. And the question that I've got from Steve was a bit of a shout out to the podcast as well. So we do run 2 podcasts, one for the Expat Mortgage side and one for Expat Chat. The question has come from Steve. Are there any red flags to consider when residing overseas in the US and looking to buy a home back in Australia? Some further context. I'm an Australian citizen and looking to buy a primary residence in New South Wales, and I want to live in it for 6 months of the year. I'm currently still a tax resident of the US and will continue to derive my income from the US, even when back in Australia. So, I mean, first and foremost, I'll kick it over to you, Jeremy. Would there be any issues that you could, I suppose, foresee that he would get with financing if he's just employed in the US?
No. So if he's, most banks will still treat it as an investment loan because of being overseas with foreign income, and they'll assume that's been rented out. Of course, you can rent it out or you can keep it vacant after and visit it when you're back in the country. That's up to you. I guess probably more consideration around his tax status and the impact that would have if he's spending big chunks of the year in that property. So that's probably more a question for yourself, James.
Yeah, I mean, if we are going to move into the property, and it's a case where it's going to be a main residence, and then you're in between countries, US, Australia, you can't. I would say 6 months is too short. So I would say that Steve's probably in this case isn't going to rent it out. It's just going to stay a main residence. And then if the income's being derived from the US, ordinary Australian tax resident, you'll get some foreign tax credits there. Unfortunately, the ATO doesn't miss you when it comes to tax, so you'll end up paying a little bit more tax to the ATO versus the federal rates in the IRS. But outside of that, no major considerations when we're just an ordinary Australian citizen. I think probably the hardest thing would be if you are trying to buy the property asset whilst you're overseas. You know, you might not have anyone boots on the ground. So that's when you would probably look to engage someone like Jack and his team if you aren't moving back anytime soon to source that main residence. I think 85% of Jack's team, or 85% of purchases that Jack's team helps with, are actually all off market. So it just goes to show you the huge amount of potential that we don't see when we're looking on realestate.com. So there is a significant value there. I've got another one from John, and I'm just reading out as it is. Are there any withholding taxes I should be aware of when selling the property? I'll address that one quickly. The main one from withholding taxes will be the foreign resident capital gains withholding tax. Any property that we're selling over 750,000 attracts 12.5%. You will get that tax back in the event it's meant to be an exempt transaction. But it's just a way that we actually pay the ATO, I suppose, first before the financial year is up, and then we get that tax back if we're owed it. If it's a normal investment property transaction or a capital gains tax event, that's actually when we're just paying a bit of tax upfront first, and then we might have a bit more tax. But there's a bit of tax planning there that can be done. Question for Jack on what his thoughts are on the property outlook for the next 12 months. Is he focusing on any particular areas, capital cities? There you go, Jack.
Very good. So I don't really get too into the micro of what's happening in the marketplace, because as everyone's seen over the last 12 to 24 months, even the so-called experts have no idea what's going to happen. So I always keep our investing and property buying with the fundamentals, which is buy in good quality locations where you have a strong demographic. You always want to be buying established property as opposed to brand new property, just simply because you will always get stronger growth out of an established property as opposed to a new property, because the larger portion of the value is in the land, which is what appreciates, as opposed to the beautiful dwelling on top of that land, which is what depreciates. Even though you get some beautiful tax concessions out of depreciating a property, you make real wealth out of properties growing in value, not the tax concessions you can make. I think over the next 12 months, we'll see some more inventory come to the market. We're already starting to see that now. I think the inventory that will come to the market will be subpar. It won't be A-grade assets at any price point. The people who will sell and what they will sell will be investment properties first, and most people don't hold the greatest investment property. So there'll be, I think, a bit of a glut of B and C grade stock on the market in most areas. And I also think what we're seeing, which is a bit of a trend, is that affordable markets, so places like Perth, for example, a lot of regional hotspots as such, will be big talks in the investment circles or property investor circles because of their affordability. One thing I advise and urge people to do is, if you're going to go invest into a location, just have a quick search of what that location's done over the last 20 to 30 years. Make sure that it has had consistent performance and it hasn't been a market which is cyclical. Perth's very reliant, for example, on mining, and mining's doing very well at the moment. But as we know, that changes like the wind. So we just want to make sure that we're investing in good quality locations and not getting caught up in short-term metrics, which we know change every day.
Yep, absolutely. And a question for you, Jeremy. Is there a typical loan to value ratio or deposit requirement when buying an investment property?
Good question. So, answer it two ways. To have more more options as an expat or a greater spread of lenders that we can work with, I would aim for a 30% deposit. So 30 plus your stamps and closing costs. So let's say that's 5%. That may be a bit much to swallow. There are lenders now, as I said on the slide earlier, you can go down to a 5% deposit. So that has relaxed a bit. So that would be 5% plus essentially up to the 2% mortgage insurance you'd have to pay, so maybe 5-7%, and then plus the closing costs, so that you could be looking at, say, a wash up of maybe 12% all in as a minimum. But obviously, if you can aim for that 30%, we're going to have more banks to work with, perhaps a bit more flexible with their lending policy as well, and potentially better rates as well.
Yep. And I'm just sharing, if you do need a bit of a review of your loans or looking just to have a general consult with Jeremy and his team, you can just use that QR code. And I'll move through and show a few more QR codes as well, but that's really easy for you just to get in touch with Jeremy. Jeremy, another question for you that's just come through about getting finance through a trust. And some of these questions we've probably addressed actually on our podcast and in previous episodes as well, but when getting finance through a discretionary trust, are there minimum requirements, or how is it actually assessed if there's nothing actually in the trust?
Well, it comes down to, because obviously the trust is the trustee is the borrower, and you have to look at who's controlling the trustee, is an individual or corporate, and they're essentially the person that will be providing a servicing guarantee for that entity. Excuse me. So that would still look at your income and expenses. Now, as an expat trying to buy into a trust, a lot of my banks will just say, nope, we're only going to lend to individuals as an expat. So it becomes very difficult if that's the structure that you want to go down as an expat. Obviously, if you're trying to buy into a trust and get financing and you're in Australia, the more banks will come to the party.
Yep, makes sense. And question around land tax. So Jess has sent in just a question around, received my land tax valuation recently, and it's gone up by a significant amount over the 12 months. Is there any way to challenge it and push back on the Office of State Revenue? I've dealt with this personally, actually, and you can, surprisingly, and I reckon there wouldn't be too many people who would know that. So any land tax valuation you get on, say, a single property, you can challenge. You can submit a request to challenge it, and then you can get an independent valuer involved, such as Option Solutions. In the event you're successful, it just means that the amount that's payable for that year, whether it's a couple of $1,000s, would probably just be reduced in the event you are successful. But just know that it can go both ways. You could get a valuation done, and the valuation from the independent valuer could come back higher, which puts you in a bit of a tough, I suppose, position. But yes, on land tax valuations, you can push back and try and challenge it. There's a process. Each state and territory is a little bit different, and it's just important, I suppose, to be mindful around that, and that's a tough one. But I've seen that firsthand, personally, and then also with a client recently as well. So you can push back. The question here around interest charges on overdue land tax. Land tax seems to be getting a bit of a theme here. What is the general interest rate that OSAs can apply? It just depends on the state, but it's nothing like the cash rate, the RBA cash rate. It's a lot higher. I think historically, when you go back and look at New South Wales, it's ranged from 8 to 13%. So they do hit you pretty hard if you've got any land tax payables outstanding. And that was a good example of that Victorian case I gave earlier, where they actually had one that was worth about just over $200,000. That's the bill that they owed, just from sticking their head in the sand and not really paying attention. So it's a really important one. A question here about valuations. When valuations are done on properties, are they paid by the bank, or do you have to do it when you're going through these sorts of financing? It's probably one for you, Jeremy.
Yeah, very good, very good question, because it's how long's the piece of string? So it depends on who you're working with. Are you working with, say, a larger bank with your finance? Typically, that valuation's covered unless it's a lot of, so if you're doing a purchase, a lot of the larger banks or even the mid-tiers will now adopt the policy of using contract to sale as the valuation, or a desktop to back that up. If you're working with some of the smaller ones that don't have that technology, they will get a full valuation done in short form, and they may cover up to $300 as part of the application. And if it's under that, nothing out of pocket. If it's above that, you pay the difference. Whereas some banks I've seen will charge the full amount, and they'll get a quote and maybe $500, $600, $700 that you have to pay at settlement, or as part of that formal approval process, they'll charge your credit card, or you'll make a payment of an invoice before they'll progress. So it really depends on the bank you're working with. So just, it's a good question when you're looking at your options. That's probably something to think about, because it is hard for a broker to quote what that is upfront when you're looking at all your different banks, because there's a matrix of how they'll arrive to that figure. And of course, if it's a higher value property, let's say 3 million plus that you're looking to buy, some banks' policy will say, no, we need a full short form valuation, which may come in at much higher cost, because valuers will see that and they'll charge a higher quote to the bank, which is then, depending on the bank, can get passed on in full to the client.
Yep. And a question for Jack, which is mainly regarding what you see on valuations from realestate.com and On the House and Domain. How accurate do you think the valuations are on those kind of websites when you're sort of looking up a property? Are they accurate? Are they pretty far off?
Pretty inaccurate, and the reason for that is because they don't take into consideration anything other than the criteria and the land size or the floor space of a property. So, you could have 50 properties on the same street, 30 of those properties could have views of the water or the city, and the other 20 do not. The automatic valuation has no idea about that. That doesn't know about whether the property's been renovated. They don't know whether, there is a water tower behind the property that impedes on your privacy. So there's so many variables, and they're usually extremely inaccurate. And just on Jeremy's piece as well, on the renovation and development piece, most valuations that I've done for myself and clients have usually had to be paid for valuations for construction finance, and they can usually be a couple of $1,000s.
Yep, great. And then another question here. Appreciate your question, Hugh. Jeremy, this will be for you, mate. So is there any upper age limit that banks will lend for a rental property? I guess where banks, they have an appetite. Is there an age, but they just don't lend over anymore? What are your thoughts?
So that's called exit strategy. It does just depends on the profile, asset and liability position of that borrower. And then, so if let's say they're a little bit on the other end of their working life, maybe 55, and they've got perhaps 5 years of working left before they plan to retire. Okay, well, there's a couple options. You take a loan up over the 5 years to hit retirement, which may be hard to hit with servicing. New loans are stress tested nearly 10% now, so to maybe qualify over a 5-year period, very hard. So let's say you said, okay, we want to take this loan over 15 years, but for that last 10 years of that loan, we'll plan to be retired. What's your balance sheet look like? If it's an investment property and it's going to take care of itself, the bank may not be as concerned if you've got your own dwelling. But perhaps if it's something you're going to move into in retirement, well, we just need to make sure we've got other assets to pay out that debt at retirement. So you may have, 2-to-1 ratio of superannuation or shares that you're going to plan to liquidate to extinguish that loan. Then that's fine. The bank's really concerned. Their key concern is once you hit retirement, you've got a place that you can live in, and they don't want to kick you out because you can't pay a mortgage and you've got no income coming in. So we need to make sure there's other assets.
Yep. Okay. Yep. Good. And then Jack, just a final question for you. Do you have an ideal client at the moment, or is there a pretty broad spectrum in the types of clients that your team is helping at the moment?
Great question. So naturally, the clients we're working with at the moment usually have strong incomes for servicing. So we don't look at anything under $500,000,
Yep.
and we're usually buying in either regional hubs, so places like Geelong, Newcastle, or we're buying in major capital cities. So naturally, you need to have the ability to be able to buy properties in those locations.
Yep.
That's the kind of clients from everyone from CEOs and founders of major companies to first-time buyers getting into the marketplace and just want assistance.
Yep, and I know from personal experience, especially with one of my clients, Gary, he just can't speak highly enough of Henderson and Jeremy working as a team. So that was a really good outcome. That's all for today's webinar. if you are interested in obviously our socials, jump on there. I've just seen that Twitter doesn't really exist anymore, so that's obviously an old slide. That's creative, that one. But we are doing a webinar series, ladies and gentlemen. So we are going to be doing our next webinar as following this property series early October. If you do want to find out more about that, jump on our events page on the atlaswealth.com websites, and you can already register for that. The next ones are going to be touching on buying your first home or your first property back in Australia as an expat, things to consider, things to know, some good little nuggets in that one. In the meantime, we really appreciate you joining us today. And in the meantime, we'll be sending out the recording. If you have any queries, questions, please feel free to reach out on that email and I'll divert it to one of the specialists that are on today's call. Thanks, guys. Appreciate your time today.
Thanks, guys. Thank you. Appreciate it.
You.